Hi, it is my hope that you is well and keeping safe. Welcome to the sixth topic of financial management that covers dividend decisions. Dividend decisions is one of the main four functions of a financial manager. Uh, Under dividend decisions, the question arises on what to do with earnings, which would also call incomes or the net profit that are declared in the financial statements of a business, and to be specific, the income statement, also known as a profit and loss account. So, the question arises on what to do with these profits. Do we pay dividends or do we retain these profits for further reinvestment and growth of the business? So take this as an instance. So at the end of the year, the business has declared profits. So the question will therefore arise on what to do with these profits. Do we pay dividends to the shareholders out of these profits? Or do we retain these profits for further reinvestment and growth of the business? Or the question would also ask, how much out of these profits do we pay as dividends and how much do we retain as retained earnings for investment and growth? So therefore, dividend policy determines the division of earnings between payment to stockholders or the shareholders and the investment of profits in the firm. So the key role of a financial manager in this decision is to keep a balance between the dividend needs of the shareholders and the growth needs of the firm. Importance of dividend decisions. Dividend decisions are an integral part of a firm's financing decision. So if you go back to the first function of a financial manager, that is financing decisions, you remember we looked at the sources of finance. One of the main sources of finance for a business is retained earnings. Retained earnings will arise after we've decided not to pay dividends out of profits. So what we remain with as a business is retained earnings. Retained earnings is a source of finance to the business. So therefore, we can say that dividend decisions will affect the financing decision of a business. Because if we retain profit, this retained earnings will serve as an extra source of finance for the business, and it can be used to finance its profitable investments, and therefore the business will end up growing. So when firms retain profits, then they may not go to the financial markets to borrow or issue more shares to raise finance because they have raised some of their finances through retaining of their profits. Dividend decisions, we look at the following aspects. So one is how much dividends to pay. So do we pay high dividends or do we pay low dividends? If you pay low dividends, it means that you are retaining. If you pay less high dividends, it means that most of our profits are going out. We have less financing. So how much to pay will be covered by the following key items or policies. That we may have a constant amount of dividend per share. We may have constant dividend payout ratio. We may have fixed dividend plus extra. And also we may have a residual dividend policy. The other aspect of dividend policy is when to pay. So dividends can be paid in the interim, that is interim dividends that are paid before the year ends, or they can be final dividends that are paid after at the end of the year when the profits have been declared. The third aspect of dividend decisions is why dividends are paid, and this is supported by several theories, dividend theories. So we have the residual dividend theory, we have the dividend irrelevance theory by Modigliani and Miller, or in short, M&M theory. We have the signaling theory, we have the bird in hand theory, and we have the clientele theory. And then lastly, the last aspect of dividend decisions is how to pay dividends. Yeah, so dividends can be paid in two forms. That is, it can be paid in the form of cash, as in the shareholders receive cash from the business as dividends, or it can be the form of stock dividends, where shareholders are given extra shares. So how much to pay? So the question here is on whether do we pay high or do we pay low. So how much to pay? We have several dividend policies. One is a constant payout ratio. Yeah. Here, a firm will pay a fixed dividend rate. Yeah. So the fixed dividend rate will be multiplied by the earnings per share of the business or the net profit of the business. Yeah. To determine how much the dividend the business is to pay. So if the dividend payout ratio is high, then dividends paid will be high, and if the dividend payout ratio is low, then the dividends paid will be low. Again, the dividend per share under this policy will be dependent on the profit that the business has generated. So if the business has generated high profits, the shareholders will get more dividends. And if the dividends has generated less profits, the shareholders will get less dividends. So take for instance, in our case, 40% dividend payout ratio. Yeah, assuming the business has made a profit of 1,000 shillings, that will be how much profit? How much dividends? 40 times 1,000. That's 40 times 1,000. Yeah. Okay, it will be say 400 shillings. Yeah, for 1,000 shillings profits. Assuming the profits go up by 100 to 2,000 shillings, 40% times 2,000, that will be 800 shillings. So you've seen that the dividends will go up based on the amount of profits that have been reported by the business. So the higher the profits, the higher the dividends under the constant payout ratio, because the dividend is dependent on a fixed dividend rate, and the fixed dividend rate will be multiplied by the profits or the earnings per share to determine the dividends to be paid to the business. And then number two, we have the constant amount per share or the constant dividend per share. So under this policy, the dividend paid per share will be the same regardless of the profits reported. Whether the profits are high or whether the profits are low, the dividends will be same irrespective of the earnings level. So if the firm has decided that it will be paying a dividend of say 2 shillings per share, it will be 2 shillings per share, whether the profits are very high or very low. Yeah, so this creates some certainty. Shareholders always know that this company will pay them a dividend of 2 shillings every year, so long as the business has reported a profit. Yeah, so the constant amount per share. So in this case, the dividend per share will be fixed irrespective of the earnings level. Then we have the third policy, that is a constant dividend per share plus extra. Yeah, so this is a combination of number two, that is a constant amount per share, that is 2 shillings, plus an extra depending on the profits that the business has made. If the business has made high profits, then an extra is added. Yeah, so if the business has made high profits, then some bonus is given to the shareholders. Yeah, because the super extra profits have been made. Yeah, so that is a constant dividend per share plus an extra or plus a surplus. So under this policy, a constant dividend per share is paid every year. However, extra dividends are paid in years of supernormal earnings. So the shareholders receive an extra or a surplus if the business has reported extra profits. And then we have a residual dividend policy. Under the residual dividend policy, dividends are paid out of earnings after the investment decisions have been financed. Yeah. So after the business has declared its profits, then the management first thinks of investing these profits in the profitable investments in the business. If there are no investments available, then the dividends are distributed to the shareholders. But if there are profitable investments available that the business needs to invest into, the business first retains these profits to finance these investments. And then what remains after the investments have been financed is then distributed to the shareholders. So say for instance, the profits are 1,000 shillings, and then the business happens to have a profitable investment that it wants to make of say 600 shillings. So the business will first retain 600 shillings to finance this investment, and then what remains, that is 400 shillings, is then distributed to the shareholders. So the 400 shillings that remains is a residue. So the shareholders will therefore get a residue of the profits after investment opportunities have been exhausted. So those are the dividend policies of how much to pay. So they're determined by those four policies that we've looked at. That is a residual dividend policy, the constant dividend per share plus extra or surplus, and the constant amount per share, and constant payout ratio. We then move forward to the next aspect of dividend policy, that is when to pay. Yeah. So dividends can be paid in the interim or at the end of the year after the profits for the year have been declared. So you can therefore have interim dividends that are paid in the middle of the year. And then you can also have final dividends that are paid at the end of the year. Then we move on to the other aspect of dividend policy and decisions. Why pay dividends? So this is supported by several theories of dividend. So we shall look at them in brief. Yeah. So we shall look at this theory very briefly. So I hope that maybe in your own free time, maybe you can go research on these theories and get a deeper understanding. But in this case, let me look at them in brief, but hopefully you get to understand briefly what these theories talk about. So dividend theory, we have the first one, the residual dividend theory. So at this theory, a firm will pay dividends from the residual earnings. That is, earnings remaining after suitable projects with positive net present values have been financed. So in this case, for this theory argues that for a business to maximize its value, then on matters regarding dividends and dividend decisions on whether to pay dividends or retain, the firm should, after declaring profits, should first reinvest these profits in the profitable investment opportunities that are available to the firm. And then after exhausting these investments, uh, after having satisfied these investments by financing them through the retained earnings or through profits, then what remains is a residue. It can be shared to the shareholders through dividends. So that is as per the residual dividend theory. So that a firm should pay dividends after all profitable projects have been financed. Then after all the profitable businesses have been financed, then what remains, that is the residue, can be shared to the shareholders in the form of dividends. And then we have the second theory, that is Modigliani and Miller theory, and that is the M&M dividends irrelevance theory. This theory argues that the dividend policy of a firm has no effect on the value of the firm. Yeah, it doesn't have a effect on the value of the firm. So whether the business pays high dividends or low dividends or no dividends at all, or whether or the firm doesn't retain any earnings at all, this decision will not have any effect on the value of the firm. Modigliani and Miller argues that the value of the firm is mainly dependent on these two factors. That is, one, ability to generate earnings from investments, and two, the level of business and risk. Those are the only two factors, according to Modigliani and Miller, that will affect the value of the business. Yeah, that is a business's ability to generate profits. One, and two, the level of risk that the business is exposed to. The dividend theory has no effect at all, at all, at all. Yeah. So long as it doesn't affect the earnings ability of the firm, dividends, according to Modigliani and Miller, have no effect on the value of the firm. And then number three theory is the bird in hand theory. That this theory argues that shareholders prefer dividends that they are sure of, yeah, to capital gains that can be generated from the stock market in the form of share prices. Yeah. So from an investment in shares, if you invest in the shares of a company, you expect to earn returns through two main ways. One is through dividends, and two is through the increase in share prices in the stock market. So say for example, you bought a share at 5 shillings, you sell it at 8 shillings, you've gained a return of 3 shillings. That is also a return to you. The return generated from the stock market is also known as capital gains, and the return generated from dividend is known as a revenue gain. So a shareholder can earn his return through dividends, that is a revenue gain, or through the increase in share prices, that is a capital gains. So under the bird in hand theory, this theory advocates or argues that shareholders prefer that certainty of dividends. Yeah, when a firm declares dividends, the shareholder is sure that he has a return, as opposed to the stock market, which is highly risky. The prices may go up, the prices may go down. So the shareholder is not certain about the returns from the stock market. But in the form of dividends, the shareholders will be sure. So the bird in hand theory argues that for firms to maximize their value, they need to pay high dividends. Yeah, because those firms that pay high dividends will attract shareholders. Yeah, and the more shareholders they attract, the higher the value of the farm will go, because the forces of demand and supply. Yeah, the higher the demand, the higher the price. The same case will apply with shares. If the shares have a high demand, they attract more shareholders, the demand will go up, which means that the price of these shares will go up, which will also mean that the value of this share in the financial markets, in the stock markets, will go up. So therefore, the bird in hand theory advocates for an increase for higher dividends so as to maximize the value of the farm. And then we have the fourth theory of dividend decisions, that is information signaling theory, the signaling theory of dividends. According to the signaling theory, it assumes that if the management pays high dividends, it signals high expected profits in the future to maintain the high dividend level, and vice versa. And vice versa is to say that if a firm pays low dividends, it signals low expected profits in the future. So because the firm, in this case, the firm is signaling its future earnings expectations. Dividends are usually paid, in most cases, dividends are paid in cash. So for a firm to pay dividends, it must be sure that it will be able to generate that cash in future to pay dividends. So if a firm pays high dividends, it signals the management's belief that the firm will be able to generate sufficient cash flows in future to pay those dividends. And in the other case, if the management pays low dividends, it signals the management less belief in the business in generating cash in future to pay dividends. So the management is sure, believes in itself that it will be able to generate high profits, high cash flows in future. It will be able to declare high dividends because it believes that it will be able to generate high cash flows to pay these dividends, and vice versa. That is according to the signaling effect theory that was advanced by Stephen Ross in 1977. And then you have the clientele effect theory, advanced by Richardson Petit in 1977. So according to the clientele theory, the shareholders of a firm are the ones referred to as a clientele. So the clientele theory refers to the shareholders as the clientele. So this theory assumes that the clientele can be split into different groups. And according to the clientele effect theory, the shareholders are divided into two clienteles. That is the low income earners and the high income earners. The low income earners prefer high dividends, yeah, to high share prices. They prefer certainty. The low income earners will prefer high dividends to gains from the stock market. So, okay, going back to the revenue, dividend returns and capital gains returns. So, the low income earners will prefer the revenue returns to capital gains. They prefer the dividend returns to capital gains, whereas the high income earners will prefer capital gains to dividend returns. Yeah, that is according to the clientele effect. So what happens if a business pays high dividends? This business, according to the clientele effect, it will attract low income earners as shareholders. If a business pays high dividends, it will attract low income earners. And if the business pays low dividends, it will attract high income earners. So I hope you get the difference. If the business pays low dividends, it will attract high income earners, and if it pays high dividends, it will attract low income earners. So I repeat, if the business pays high dividends, it will attract low income earners. If it pays low dividends, it will attract high income earners. So high income earners prefer those firms that retain their dividends because they know that these dividends will be reinvested and the business will grow. And if the business grows, its value increases over time. So the high income earners may look at the long term. The low income earners will look at the certainty. Yeah, they are not well off in their pocket, so they want that cash as quick as possible. So they'll go for high profits. I hope you get the difference. So with time, the business will have a certain clientele of shareholders. Yeah. So if the farm has been paying high dividends, the farm will likely be having low income earners. Am I mixing myself? So maybe let me repeat. If the farm has been paying high dividends, the farm will have attracted low income earners as its shareholders. So if the farm happens to lower their dividends, these shareholders will leave the farm. And if they leave the farm, it means that they will be selling their shares. So the supply of these companies' shares will go up, which will lead to a decline in the farm's prices. And a decline in the farm's prices means a decline in the value of the farm in the stock market. So, which means here that a disruption in the level of dividends will therefore lower the value of the farm. So, according to the clientele effect, is that over time, depending on the level of dividends that the farm has been paying, the farm will attract a certain clientele of shareholders. Yeah, that is either low income shareholders or the high income shareholders, such that in the future, if the company disrupts the level of dividends, then these shareholders will decide to leave the farm. If the shareholders decide to leave the farm, the value of the farm will decline in the stock market because of the oversupply of the shares in the stock market, which will lead to the decline in the price of the shares in the stock market. And that is as per the clientele effect of dividend theory. So those are the dividend theories. Next, we look at how to pay dividends, the form of paying dividends. So dividends can be paid either by cash or by stock dividend, also known as a bonus issue. We can have a stock split or a reverse split. We can have a stock repurchase or the rights issue. To discuss in class. Anyway, discuss them here. So the first form of paying dividends is through a either cash or bonus issue. Cash dividends are quite obvious. In this case, the shareholders receive cash. Yeah. So you've invested in the shares of a given company, say Safaricom. On a particular day, you receive an SMS in your phone, M-Pesa confirmed. You have received 1,000 shillings. Yeah. That is a cash dividend. Where we can also have a bonus issue. A bonus issue is also known as a stock dividend. A stock dividend is instead of the business paying cash, the business gives you an extra share. So if you had 3 shares, you are given another share or another 1 share, then you end up with 4 shares. That 1 share you've been given is a dividend. It's known as a stock dividend, also known as a bonus issue. So a bonus issue involves the additional issues of shares for free. So dividends can be issued in the form of cash or in the form of dividends. That is a stock dividend, also known as a bonus issue. That is a free share given to the current existing shares. So the bonus issues are a form of earnings retention. Yeah, it's a form of earnings retention. That is, instead of giving them cash, we retain this cash and give them an extra share. Yeah, it's like we have sold to them the share for free, and the opportunity cost of issuing this free dividend is the retained earnings, the profits that we fail to distribute to these shareholders. And these retained earnings can be reinvested for the further growth of the firm and as such. And then the other forms of paying dividends is the stock split or the reverse split. So stock split is when a share is divided. Yeah. So you have a share of say 10 shillings, which is divided into two shares of 5 shillings. That is a stock split, shares split. And the other form of dividend is reverse split. The reverse split is also known as stock consolidation or share consolidation. So like you you may be having two shares of 5 shillings each, and the two shares are combined into one share of 10 shillings. Yeah, so that is stock consolidation. So share split is where a block of shares is broken down into smaller units so that the number of ordinary shares increases and their par value decreases. And the stock split is meant to make the shares of the company more affordable by low income investors and increase liquidity in the market. So if the shares of the company have, the value has increased uh, much in the stock market and they become unaffordable because the price is quite high. So to make this share affordable in the stock market, then we split it into smaller shares of lower prices so as to make these shares affordable. And a reverse split is also known as a stock consolidation, is the opposite of stock split and involves the consolidation of shares into bigger units, thereby increasing the par value of the shares. It is meant to attract high income clientele of shareholders. Yeah, when you make them more expensive, you make these shares attractive to high income earners. And then another form of dividend is a stock repurchase, also known as a treasury stock. As treasury stock is happens when the company buys back its own shares from its shareholders. The company buying back its own shares from its shareholders. It's like the company investing in itself. Yeah. So that the company is its own shareholder. That's a reverse stock. So the shareholders will get its dividend in form of the cash it receives from the business when the business buys back its own shares. Yeah. So the shareholders will benefit in the form of receiving money from the company. Yeah. So the company can also buy back some of its outstanding shares instead of paying cash dividends. This is known as a stock repurchase. And the shares bought back are known as treasury stock. So those are some of the forms of paying dividends. Then next, look at the factors to consider in paying dividends. Factors to consider when paying dividends. So these are the factors that the firms in the dividend decisions deciding on whether to pay dividends or not, or how much dividends to pay and how much to retain is dependent on the following factors. Number one is the legal rules. The company has to follow the law in declaring these dividends. So these are some of the laws that the business has to follow. One is the net purchase rule. According to this rule, is that dividends can only be paid out of the company's profits. So this rule states that that dividend may be paid from the company's profit either in the past or in the present. That dividends can only be paid out of profits. Therefore, it is illegal to pay dividends out of capital. It is illegal to pay dividends out of capital. Number two rule is the capital impairment rule, which prohibits the payment of dividends from capital. So legally, a firm is not required to pay dividends out of capital. The firm can only pay dividends out of profits. If the company has not declared profit, if the company has not made profit, it will be illegal for this business to pay dividends. So dividends can only be paid if the business or the company has made a profit. And then the third rule is the insolvency rule, which prohibits the payment of dividends when the company is insolvent. That is when the company's assets are less than liabilities. So this is another rule, legal rule, that the business has to follow when making a dividend decision. So if the company is insolvent, this company shouldn't pay dividends at all, at all. Then another factor to consider when paying dividends is profitability and liquidity. So this is obvious. If the business is not profitable, it cannot pay dividends. The dividends will come out of profits. So it's obvious. So if the business doesn't have profits, then it cannot pay dividends. If it has profits, then it can pay dividends. The same case with liquidity. For cash dividends, they must be paid out of cash. So if the business doesn't have cash, if the business doesn't have sufficient cash, it cannot pay dividends. How will it pay if it doesn't if it doesn't have cash? The business must have cash to pay dividends. So profitability and liquidity is one of the main factors that determine how much dividend the business has to pay. If the business is not liquid, if the business doesn't have cash, it cannot pay dividends. And if the business is not profitable, it hasn't declared profits, this business cannot pay dividends. And then number 4 factor is the investment opportunity. For rational managers, if the business has an investment opportunity that it needs to take advantage of, if these managers are rational, they will not pay dividends. They would rather retain these earnings and take advantage of this profitable opportunity so as to increase the value of the farm in future. And that is by reinvesting these assets in this very profitable opportunity so as to grow the company and also to grow the profits of the company in future. So with investment opportunities available, you'll find that managers or businesses will not pay dividends. And businesses can only pay dividends as a residue. That is, if or after the available investment opportunities have been fully financed out of these dividends. So dividends is a very cheap source of finance for the retained earnings is a very cheap source of finance to the business. The business will not pay interest for retained earnings. So retained earnings are quite cheap. Yeah, the business will not have to go through the process of flotation cost, the many process of advertising for these shares, the process of evaluation of assets so as to obtain financing. So it's quite a free source of finance. Yeah, so it's quite easy to finance using retained earnings if the business has made profits. So rather than the business going to borrow from the bank or going to the stock market and trying to plead with the public to buy its shares, it would rather invest easily through retained earnings. So when there are investment opportunities, the business may not pay dividends. Then the capital structure of the business. If the capital structure is basically the mix of the sources of finance of the business, and in most cases, mainly the capital structure is made up of debt and equity. So if, say for instance, the capital structure of a company is highly geared or highly levered, that is to say that the debt portion of the capital structure is higher than equity, the firm is at a risky position, is at the risk of insolvency, is at the risk of bankruptcy, is at the risk of winding up because of high debt in its capital structure. So to balance this mix of debt and capital and equity, then the business will have to make a decision on whether to pay dividends or not. So if the business is highly geared, highly levered, where the mix of the proportion of debt is higher than equity, the business will need to retain earnings so as to increase the portion of equity in the capital structure. So a company's management may wish to achieve an optimum capital structure uh, by paying dividends and retaining more profits so as to increase its equity in the capital structure. And then another factor is the growth stage of the company. So dividend policy is likely to be influenced by the firm's growth stage, e.g., a young and rapidly growing firm is likely to have a high demand for development finance and therefore may pay low dividends and prefer uh, or defer dividend payment until the company reaches maturity. So it will therefore retain a high amount. So young firms that are looking towards growing, they need a lot of financing to finance their growth. And one of the ways to finance their growth is through retaining profits. So you find that young firms will retain as much as possible to finance their growth. Whereas for the old farms that have matured, they have no more growth opportunities. These farms will pay high dividends. So matured farms will tend to pay high dividends because they do not have any growth opportunities. So they may tend to distribute almost all of their profits. Whereas young farms that have very many growth opportunities and they need a lot of finance, they may not pay high dividends. Therefore, we can conclude and say high farms will pay high dividends. Young farms will pay high dividends. Matured farms will pay. Young farms will pay low dividends. High farms will pay high dividends. Then the ownership structure will also be a factor in the amount of dividends that the business will be paying. So the dividend policy may be driven by the ownership structure. For instance, in small firms where owners and managers are the same, dividend payout is usually low. However, in large firms, the dividend payout is usually high. Yeah. So okay, in small firms, you'll find, say, for instance, in small companies, you'll find that the managers are the same as the owners. Yeah. So the managers, in this case, will be receiving a salary. So in the end, all in all, you find that the owners of the business are getting something in return from the business. At least they are getting a salary, as opposed to in large firms where only a few managers are working for the firm, working for thousands of shareholders. The only way for these many shareholders to gain from the firm is through dividends. So for large firms, they may have to pay dividends to satisfy the many shareholders, because these shareholders are not working for the company, they are not earning a salary from the company. So for the only satisfaction that they can get is through dividends, or if not dividends, they sell the shares in the stock market and get the capital gain. For small firms, you find that the shareholders are also the managers. At least for these small firms, the shareholders who are working for the firm, they're at least getting something in the form of salaries. So they may not need dividends because at least they are getting salaries from the business. So the ownership structure will therefore have an effect on the dividend policy of the firm. Then you have the shareholders' expectation. Yeah, like in the clientele theory, we talked of two clienteles of shareholders. We have the high income shareholders who prefer low dividends, and we have the low income shareholders who prefer high dividends. So if the dividend policy is affected, then the firm may lose its value because the shareholders will start leaving the firm, which will affect the value of the business. So if the business maybe has a certain clientele of shareholders, say the low income shareholders, then the business has to maintain that high level of dividends. And if the business has high income shareholders, then the business needs to maintain that low level of dividends so as to sustain these shareholders. If the shareholders are dissatisfied by the business, they will leave the farm. If they decide to leave the farm, the share prices will go down, and in the end, the value of the farm will be quite low. So as such, the farm needs to maintain that level of dividends so as to sustain their shareholders. And then number 10 factor is access to capital markets. So access to capital markets is another factor. So large and well-established firms have access to capital markets, hence can get funds in easily. They therefore pay high dividends, unlike small firms which pay low dividends due to limited borrowing capacity. So if a firm doesn't have other financing avenues, then the firm may have to rely on retaining profits. If it becomes quite expensive for it to borrow, if it becomes quite hard for it to convince the public to buy its shares, then the only option the firm may have is to retain its profits to fund its growth. So if the firm doesn't have access to capital markets, if it doesn't have access to borrowings, if it doesn't have access to the stock market, then this firm may therefore tend to pay very less dividends. It will tend to retain more of its profits to finance its growth, as opposed to those, especially big firms that are able to sell shares in the public and obtain finance, and also able to negotiate with banks for loans, and therefore they may pay high dividends because they have other places to obtain finance from. But they don't, if they don't have places to obtain other finance from, then they'll be forced to pay very low dividends and retain their profits to fund the operations. And then other factors that will affect, the other factor is contractual obligations and debt covenants. So this limit the flexibility and the amount of dividends to pay, e.g., no payment of dividends from retained earnings. So the obligations from debt covenants between the business and the bank, yeah, so the contract, the terms and conditions of the contract may limit the business from paying dividends. So in this case, the lender or the bank is protecting itself against the insolvency of this business. So it may add a restriction for the firm not to pay dividends, so that at least the business has some cash flow, some cash with itself to pay the interest and loan as and when it falls due. And with that, we have that is the dividend uh, decisions topic of financial management. Thank you for being with me. Thank you for your attention throughout this video. Thank you, and may God bless you.